What is going on, everyone? Welcome back to the Retire Ready podcast. My name is Colin. I'm here with Kyle. Kyle, how are you doing today?
Wonderful, wonderful. Looking to change it up a little bit here. I know we've been doing some different examples and case studies, and we're going to kind of walk you through kind of like a 30,000 foot plan today. Is kind of giving you like a little roadmap of this household situation.
Yeah, so let's just jump right into it with this case study here. This is going to be a married couple where the husband is age 55 currently, the wife is age 56. Their desired retirement age is for the husband 61 and for the wife 62. Kyle, you want to give us a little bit more of a picture here?
Yeah, so just kind of keep in mind here. We got married couple filing jointly, taking that standard deduction, and they're in their mid 50s. They came to this realization that holy smokes, getting close to those retirement numbers. Most people retiring in their 60s, mid 60s, late 60s, and they're coming to the realization now that they need more than just diversified pie charts and a social security statement. So their desired retirement age, just kind of sitting down having that conversation, was 61 and 62, because obviously there's an age gap. Their ideal goal was to retire at the same time, and live their best retirement possible. And so 61, 62, but understand like those weren't like concrete numbers. I know some listeners or people we talk to have like a firm number or an age of like, I'm retiring at 65 or January 2030. This was like a desired number to give us a target, but they're really looking for like, what's that work optional date look like? Say, hey, could I potentially retire at 60 and just walk out, and I have everything in place to live that retirement. So when would work be optional? But their desired retirement ages for today is 61, 62.
Yeah, and as a household, they currently have an income of $270,000. More broken up, the husband makes 110 and the wife makes 160,000. There's some bonus structure in there too, but that's just their base income for the household. For their desired income in retirement is $144,000 a year or $12,000 a month net of taxes. So that's just, in our conversations, hey, we would love to make, have this income in retirement. So that's their desired income. And currently, with their assets, they have about $3.1 million. Just about a little over 3 million of that is in tax deferred accounts, about 10,000 in tax free, and another about $50,000 in taxable accounts.
Yeah, so a couple comments just on their household situation. So husband, wife both working, gross wages are pretty good, so they make a good living. And now we're going to kind of break down cash flow, where money saved. As you can see, based upon their current asset breakdown, again, they came to the realization, but you might be sitting here. Basically, what they're saying is we have a majority of our money in tax deferred accounts. And after kind of going through some processes and educating ourselves, we don't have great tax diversification. We've been great savers, accumulators, but now we need to start focusing more on cash flow and tax diversification and tax planning. So that'd be kind of my first takeaway is, great job at saving, guys. You've done a great job, but now how do we take this money and focus on the return of it? And then from like a spending goal, you know, some people do a really good job of like detailed spreadsheets and detailed expenses. But again, like this is like, I think we would like $12,000 a month, but it's not like exact after tax planning. And that's kind of what they're hoping to uncover from like the financial planning process.
Yeah, so what we're going to do now is we're going to walk through our retirement plan summary. Having these conversations with this couple, looking at where they are now, their age, their income, their goals, and then kind of walking through what that looks like as they reach and then into retirement as well. And it's just a good reminder that when we're talking about retirement plans, that it's living, it's a breathing document. It's not just a one-time snapshot. It's not just, hey, we're gonna do it once and we're done. There's always moving parts to it. So where they are now with this summary might change, but just want to walk through exactly what this looks like. So I'll let Kyle take it over from here.
Yeah, our biggest goal from building plans is we don't this is what we don't do is take a bunch of data and input it into a financial planning software, and it's just going to spit out something like, hey, 90% probability of success or 70%. It's important to use it as a guideline, but our goal was to keep it simple, right? Keep it simple as possible, but like lay out action items. So it's basically a roadmap. And there's definitely like, we're not going to dive into the weeds, but give you like a high level view of like what needs to happen and like what are the pros and cons of making choices, but like giving real life advice here. So like their primary goals were, we talked about their retirement dates, but they really wanted to focus on if they partnered with somebody, making that leap of basically what they're doing is of their $3 million in change, half of that right now is through employer plans. Half of that is outside of the employer plans, through like a large broker dealer wirehouse that most people would know if you drove by. And what they were basically what they were getting was diversified pie charts and proprietary mutual funds, basically designed to invest in before like being custom to their situation. So like their investment philosophy was basically created before they even walk through the doors. So like right now, they understand, yeah, we're going up if the markets are going up, and we've done a great job at saving, but we need a real plan. We need more than just a diversified pie charts and a social security statement. So their goals were to basically figure out how to transition to partner with somebody that is retirement focused, that knows how to get them down the mountain and shows them how to maximize their spending and tax focused. And they're looking for fee only. Next is basically restructuring current investments. So how do we restructure our investment plan here to basically maximize our returns prior to retirement? So basically they know they got about 5, 6, 7 year window here. So what needs to happen here? What type of changes need to be made to market growth, market volatility, income? And then basically they needed to figure out what's the order of withdrawal strategy. They understand like, where's money going to come from? Is it IRAs? Is it 401ks? Is it taxable brokerage? Is it Roth? When do we take our Social Security? So they wanted to lay all this out now versus waiting till 61 and then be like, all right, we're going to retire in 12 months. What do we need to do? So they basically want to lay out an order of withdrawal strategy and then really just take more of a comprehensive approach. Like their goal was to not do what everybody else is doing in their age range. Is like, they want to get away and take a comprehensive approach and like just get away from pie charts. Don't worry, the stock market always goes up. And we kind of talked about their desired spending. So like those were their primary goals. Again, their concerns were too much in tax deferred, only having pie charts, and they don't know the order of like what's coming out, how much could they spend, what happens if markets go down, what happens if markets go up, what type of investment strategy should we use now approaching into retirement, and really staying away from like target date funds and life, age-based investing and getting away from like wirehouses that you're just a number, like it's just another fish in the pond. Like, so those are the primary goals and concerns they have.
Yeah, and then when it comes to retirement, obviously, income is needed, and so there's an income plan that we talked through as well about, when it comes to you retire from your job, you lose that income, quote unquote, from your employer. Now you need income from your portfolio and other places. And so, what does that look like with the income plan side of things?
Yeah, so think income plan, cash flow. You're going to replace your paychecks. What are you going to live on? We look at, I call it retirement income plan, RIP. So basically establishing what could be spent. There's all these different spending strategies that we've actually talked about on different podcasts, but like, what type of lifestyle are you going to live in retirement? Are you just going to be like, I need $10,000 a month and keep that static for forever and just keep up with inflation? Like, that's one way to do it. There's nothing wrong with that. You might be 20 years in retirement and be like, holy smokes, like I really underspent my first 10 to 20 years in retirement, and I got a big savings pot left behind that I could have used earlier on. You could do staging where you're going to spend, more your first 5 to 10 years and then pull it back. Or you could use like guardrails approach. So as your portfolio goes up, you spend more. And if your portfolio were to pull back, you kind of spend less. So you have to understand, what type of lifestyle are you going to live in retirement? What type of lifestyle do you want to live? Or do you not know what's actually possible? What about legacy planning, all that stuff? And then from income planning, it's really like, how are you going to take your Social Security? And when are you going to claim it based upon your retirement account? So we're a big believer of doing all this work up front before you decide your investments. So plan first, invest last. And so what type of adjustments would need to be made? And we want to know those adjustments before they were going to be made. So we kind of look at their plan here. Basically, their plan from an income plan perspective can safely support about $18,000 after tax per month based upon their target retirement dates. So that's way more than kind of what they were looking for. It's not saying they have to spend $18,000, but from a spending capacity, that's what was possible. So that's about $18,000 per month after tax to allow them to spend more early in retirement. That right there tells them that the retirement dates that they gave us of 61 and 62, which again, I'll dive into a little detail, it's really out in 2030. They could technically move their retirement dates up a couple of years if they wanted to, if they just needed that $12,000. And then from like Social Security perspective, again, like how to claim it, not when to take it, how to claim it. We would recommend they're 63 and 1, and then the spouse would claim at 64 and 1. And that's going to provide around $68,000 in provisional income per year. Understanding, yes, we walk through examples. If they were to wait longer to claim it, they would get more, and they could potentially, if they lived a long life, they would collect more cumulatively. But they made that decision. We worked through it together of like that's when it makes best sense for their plan, even from a behavioral perspective of retiring early and delaying Social Security didn't make sense because they were going to execute some tax planning. And then from an order of withdrawal strategy perspective, the main idea was to spend their tax deferred money first. So live off tax deferred IRAs, 401ks, then spend tax deferred income plus Social Security, and then last spend the Roth. So basically that lays out the time horizon. And then you have to have a backup order of withdrawal strategy because you don't know what the markets are going to do and what taxes will do those first couple of years. So there's a backup. We call it the secondary. Is basically they're going to spend Roth accounts first plus their taxable brokerage and take Social Security early. Because what we don't want to happen is if the markets were to start going down their first year or two, we're not going to just keep selling a bunch of shares in their portfolio at a loss to get the same amount of income. So what they would do is they would flip the script, take Social Security early, spend the Roths. Because if they needed their investments to provide $10,000 a month, we only have to sell $10,000 per month from the Roths, not $13,000 from the IRAs. So that kind of just summarizes like what the income plan will look like from a 30,000-foot view. Again, there's way more to it. We got to optimize it and work through the details, but that's just kind of like the roadmap there.
Yeah, and then the next step of the plan is taxes and tax efficiency. As we said many times on this podcast and on the show, is that your goal is to not overpay your fair share of taxes. And so tax efficiency is key, and having a good tax plan is key as well. So Kyle, can you give us some clarity on the tax plan side of things?
I mean, yeah, just think about it. Really, in your whole life, your two biggest expenses for most individuals or households would be taxes and then housing, depending on how if you're renting or buying. But taxes, housing, and then healthcare. Well, lucky for you, unlike your grandparents, because really you think about parents, grandparents, they had pensions, Social Security, like that stuff was guaranteed to show up on the tax return every single year. So they had guaranteed income, but they couldn't control their tax bill. I basically tell my 50 to 64-year-old pre-retirees or retirees, you have control of how you pay your taxes. So your number one expense, more than likely, is going to be your tax bill the next 25 to 35 to 40 years. So how do we kind of make this plan as tax efficient as possible and pay the least amount now and later, cumulatively? So basically right now, if we just kind of look at their current scenario, they're in a 24% marginal bracket. Their average tax rate on all their dollars, I'm just going to round up, is about 16%. Currently, they have about $150,000 of room inside that 24% bracket. So some households, you have like barely no room inside the 22 or in the 24 or the 32, but they have a lot of room inside that 24% bracket to potentially do some stuff. It might make sense to consider filling up that 24% bracket. I always ask people, like, over the next 10 years, raise your hand if you think federal tax rates will go up. And most people raise their hands. I go, great. What do you want to do about it? I'm not saying they will. I can't guarantee it. But if they do, as a planner, we're just trying to check off as many boxes as we can. If taxes go up, we're prepared. We have buckets over here. If taxes stay low, we'll do this. If markets go up, we'll do this. If markets go down, we'll do this. So you're always ready. You don't have to get ready. And then as far as like tax deferred, our goal from the plan, I'm just going to summarize this, was by the year 2033, we didn't want to be forced to show more than $70,000 of IRA distributions per year on that tax return. And our goal was to have enough Roth money, whether it was Roth conversions or Roth contributions between now and when this time came in 2033, is there, we wanted about $40,000 of Roth income to come in each year. That would kind of optimize Social Security, tax plans, investments, withdrawal rates, everything short and long term. And then definitely consider Roth 401k versus the traditional Roth 401k. So that kind of just summarizes the tax plan as far as like action items and road mapping it out.
Yeah, and like Kyle said earlier, we like to talk about investments towards the end because that's, we don't want to lead with investments, but here we are going to talk about investments now, and kind of talking about what's their, target return needed now when they're in retirement, what's some target return needed in their portfolio. So Kyle, can you walk us through the investment side of things?
Yeah, so the purpose of investment management is to invest smarter. I don't have a crystal ball. Colin doesn't have a crystal ball. The guys and gals on TV don't have crystal balls. They're all going to make forecasts and predictions and kind of throw their opinions out there, whether it's fear or faith-based. So the goal of is just to invest smarter. And really what we're trying to focus on is the rate of return that's required for your plan to have the highest success rates. So for them, it was basically saying their retirement accounts needed to generate 7% real rates of returns between now and retirement. And then in retirement, it was 6% real rates of returns. Now, how you get 7 and 6, there's a bunch of ways we could do that, right? All equities, 50-50, however you want to do it. But that's what needed to happen. And then basically the short-term risk they could afford to take on from like market drawdowns, because the biggest questions like people have in the back of our mind from conversations is two things. How much can I spend? What do we do when the markets go down? Okay. So we know what they could spend and we know what to do if the markets go down. So they can afford about a minus 31% drop. If the markets were to drop, if their portfolio drops 40%, we're behind, we're off track, we're going to have to make some changes that might be uncomfortable to get them back on track. So that's what they could kind of afford from an investment perspective. And really their initial targets were going to be 100% equities right now. And then the strategies we're not really going to dive into. They're going to basically update their private investments, right, with certain investment strategies, and then do that first. And then they're going to align their employer plans with what's going on over here. So what we see a lot of time is like, this account's doing this account's, nothing's working together. So invest the private accounts first and then invest in employer plans to complement we just don't want duplicity. Like there's way too much S&P, there's way too much tech going on here. And their target balance by the time they pulled the trigger for like fully funding was about 4.2 million. That's what their targets were.
So as we said earlier, we talked about some Social Security claiming strategies and what ages they could take it. But with Social Security, we talk about taxes on your Social Security. When should you take it? With them being a few years out, it seems like it could be far away, but actually it might be a lot closer than they think. And so we're going to talk through Social Security, but more specifically the provisional income side of things and how that plays a factor in their retirement plan.
Yeah, one of the biggest questions is, when should I take my Social Security? Right? And I go, well, how long are you going to live? Right? We don't know. But at the end of the day, we have to make decisions that are in the best interest of the plan, short-term and long-term, and like remove all these variables of like, well, what if Social Security goes away? Or what if I die early? Or what if I live a long time? You just got to be able to look at the pros and the cons and look at multiple planning scenarios and be like, we can make this decision to do this and understand we're giving up this. That's what it really comes down to. It's a trade-off. So like their ideal situation was, they're going to get about $70,000 in Social Security, and about $57,000 to $58,000 of that Social Security would be taxable based upon how much they have saved in their lifestyle. Like they understand, like it does not make sense to chase a tax-free retirement and a 0% tax rate. It's not realistic. We could get there, but we're probably going to pay way too much taxes up front. Their goal is basically looking at when we look at the plan, and we can see what their effective tax rates would be over time from their spending. And it made sense for their goal was to get about to a 9 to 10% average tax rate in retirement. It doesn't happen right away, but that was like the optimized point. So we just wanted to make sure there was enough Roth income to come in to support the surviving spouse. So if one spouse did pass, there's enough Roth income to come in to replace the Social Security check. but also keep them in a low tax bracket. And our goal was to kind of achieve this over about a 7 to 10 year period of tax planning. The hard part of tax planning is it's not instant gratification. It usually takes 4, 5, 6, 7, 8, 9, 10 years to accomplish before it's all in place and optimized. So that's kind of what we're looking at. And we talk about their spending and guardrails. Like really, we had some room. Like if their portfolio was to rise to about 4.6, they could really safely spend about $20,900. They didn't have to, but they knew they could. So there's a lot of households where like we just want our $12,000 per month, but we know we have room in here if we want to pull out, hey, I need $30,000 to go to Europe, or hey, we need $30,000 to take the family on a trip. So it could just be ad hoc. They would not really have to make any changes to their lifestyle because of a market event unless their portfolio fell down to about 2.9 million. 2.9 million, they know they have to cut back to about $17,000 after tax. And that would be their adjustment to keep their plan on track, which is way more than what they said they even needed up front. So great job saving. Now it's just basically saying, how can we do tax planning to lower that tax bill long term, maximize our investment returns, potentially retire earlier, maximize our investments to live our best life, and then make sure whoever gets our money after us gets that money in a tax-friendly manner. So that's kind of like the big picture of today.
So there you have it. There's, walking through a married couple who is in their mid-50s looking to retire potentially in the next 5 to 7 years with about $3 million invested today. Kyle, any lasting words?
Yeah, just understand mid-50s, great earners, great savers. Now we're moving away from diversified pie charts. That's obviously investments are still important, but like now emphasizing more time to maximize investments, to minimize tax bills, to incorporate tax strategies, maybe retire earlier, maybe spend more in your first 5 to 10 years, maybe do more stuff with your family. So really just kind of putting targets and goals in places and to add as much value as possible to that household situation.
Well, there you have it. Thank you everyone for listening, and we'll see you in the next episode. Goodbye.
You've been listening to Retire Ready with Kyle Hammerschmidt. Planning your retirement starts now. The word retirement shouldn't scare you. Our passion is to be here to help you navigate every step of the way. We hope you've enjoyed the show. If you did, make sure to like, rate, and review. We'll be back soon. But in the meantime, for more education and information, hit up retirereadyacademy.org. And if you're ready to start your retirement planning today, go to our website at mocanwealth.com. Mocan Wealth Management is a registered investment advisor with the state of Kansas and Missouri and may only transact business with residents of those states or residents of other states where otherwise legally permitted, subject to exemption or exclusion from registration requirements. This communication is not intended as an offer or solicitation to buy, hold, or sell any financial instrument or investment advisory services.